Today, I want to talk about something that can be confusing to new investors, and that's ETFs versus mutual funds, as well as their pros and cons. Both have their uses and can be similar, but they also have some differences that you should be aware of when picking what you want to have in your portfolio. Let's jump in. So what is a mutual fund? A mutual fund is an investment fund that allows you to pool your money together with other investors to purchase a collection of stocks, bonds, or other securities. Roughly 70% of mutual funds at this time are actively managed by an individual or group attempting to beat a market index typically, and the rest are passive that follow an index of some kind. Okay, well, what is an ETF then? Well, an ETF is an investment fund traded on the stock exchange similar to a stock. Unlike mutual funds, the ETFs can be bought and sold throughout the day, and out of all of the ETFs in the market, only about 2% of them are actively managed, meaning 98% are passive and follow some sort of index usually. If you're looking for opinions on what funds to look at, I encourage you to join the Personafi app down in the description and start getting involved with the investing community. Okay, so mutual funds and ETFs are both investment funds, so how much different can they be? Well, technically speaking, there aren't any huge differences, but like most things, the devil is in the details. So let's look at some of the pros and cons. Mutual funds are up first, and the first pro is going to be diversification. This is a fundamental principle for long-term investing and belongs in everyone's strategy in my opinion. By buying a mutual fund, you can be buying into hundreds of companies with just one click. The second pro is the overwhelming amount of choice when it comes to what kinds of mutual funds are out there. You can buy into certain sectors, indices, and anything else you can think of. The third pro here is access to low-cost index funds. These are really important, especially if you're a new investor. You shouldn't just be out there buying single stocks and getting overwhelmed on how to do your best DD or due diligence. Instead, you should start dumping money into low-cost index funds while you learn all that other stuff and let it grow over time. This might save some of you from buying hype stocks at their peak and losing 50% in a week when you could have just been spending that time learning while your money was safe and growing in an index fund. The fourth pro is the ability to buy in increments. Mutual funds don't have to be bought in whole shares. If you have $500, there's no need to figure out how much you can buy by looking at the cost of the fund. You can just throw your money in and you're good. Kind of like fractional shares buying with some brokers. This leads to my last pro, the ability to automate your investing. Let's say you get paid every 2 weeks and are trying to be more consistent as a new investor. Well, with a mutual fund, you can set it up for every 2 weeks when you get paid. A certain amount will be moved into a mutual fund without having to take the time to do it yourself. And since they allow for basically fractional shares, you don't have to calculate how much you're going to be able to buy. It will just happen automatically for you. This covers another principle of long-term investing, and that's time in the market versus timing the market. You auto pay your bills, so they get done on time, right? Why wouldn't you do the same for investing? Okay, so let's look at some cons now. The first con is required minimum investment to get into a mutual fund. This isn't as big of a deal as it used to be and will vary from fund to fund. For example, Fidelity doesn't have minimums on almost anything anymore due to market competition, but Vanguard still has a $3,000 initial investment to get into a bunch of their mutual funds. Like anything of this nature, it's subject to change, and I have a feeling as time goes on, even more places will be dropping this minimum requirement to stay competitive in the marketplace. The second con is that mutual funds aren't as tax efficient as ETFs overall, but only when talking about actively managed mutual funds. This is because these managed funds will have a fund manager buying and selling throughout the year to try and beat the market, and just like any investor buying and selling, it creates a taxable event. To see how much buying and selling is going on in any given mutual fund, you can look at the fund's turnover rate. This tells you what percentage of the mutual fund's holdings changed over the last year. A high turnover rate might mean a slightly higher tax bill at the end of the year for someone holding it versus someone holding a passive fund that didn't change in terms of their holdings as much throughout the year. The third con is trading fees. Just like with minimums, this is starting to become a thing of the past, but I felt like I should still mention it, especially if the funds you're looking at are from a different investment firm from the broker that you're using. Some places will charge you $40 or even more to trade another broker's mutual fund, so keep an eye out and don't ruin your day by losing $40 to fees. If you hate fees, hold up. If you hate anything, go ahead and leave a like. If you don't, you're a liar. We all hate something. Me personally, I hate the sun. There's no love for gingers on a sunny day. The last con isn't much of a con in my opinion, but it might be for some. Mutual funds are only traded at the end of the day. This means that if there's a weird dip in the market, you can't take advantage of it in the short term by buying that dip during the day, since you can't buy and sell like a normal stock. So let's take a look at ETFs now and some of their pros. A few of these are the same as mutual funds. They're good for diversification, there's a huge variety of choice to meet your investing needs, and they offer low-cost options for index funds. The fourth pro is where we diverge a little, and that's with no investment minimums. ETFs, no matter what company they come from, don't have required investment minimums to get into them, which is great because fees suck. What doesn't suck is getting free stocks, so use my referral link in the description for Webull and get you some. The fifth pro is they're generally more tax efficient than mutual funds since almost all ETFs are passively managed and there isn't a very high turnover rate, creating taxable events for their holders. Remember though that passive mutual funds are just like this. It's the actively managed mutual funds that tend to have higher turnover rates and are less tax efficient. The last pro for ETFs is the ability to buy and sell intraday just like a stock. If an ETF takes a dip in the morning, you can buy that low spot, unlike a mutual fund that won't be traded until the end of the day. This is a plus for an investor who wants to take a more active role in trying to get the best price. Just don't end up waiting for the best price for 8 months and end up forgetting to invest at all. That's no bueno. So on to the cons. Unlike mutual funds, there isn't a way to set up automatic investing with ETFs. You have to remember to go in on payday every 2 weeks and buy your ETF. This doesn't sound like a big deal until you realize most people have the memory of a mouse and can't be trusted to even cancel the 4 extra streaming services they haven't used in the last 5 years. Con number 2 is some may still have trading fees, but this is more of a broker thing and has rapidly disappeared over the last 5 years or so. Most reputable brokers don't charge any commissions on buying and selling ETFs. If your broker does, I would recommend getting a new one. Almost all market competitors have zero commission-based trading now, especially on ETFs. Check out my other video that goes over the differences in some major brokers if you need a new one. The last con with ETFs is that you can't buy in increments, most of the time. Some brokers like Fidelity will allow for buying of fractional shares of ETFs, but lots still don't allow this. This means if your ETF that you want to buy costs $400 and you only have $200, you're out of luck. So go put some gas in your car and get driving to work. Or get a broker with fractional shares. That's always a good option too. Last thing to consider with mutual funds and ETFs is expense ratios. So here's a chart I made. Overall, when looking at all funds lumped together, mutual funds have a higher median expense ratio at 0.88% compared to ETFs median being at 0.50%. But hold up. When you look at mutual funds that just follow indices, which are passively managed if you remember, mutual funds come in at 0.33% and ETFs are sitting at 0.47%. This isn't a chart that just says one is better than the other regarding expense ratios. This is meant to show you the importance of shopping around. Looking at averages and medians isn't always the best strategy. Competition has created very low expense ratios for both mutual funds and ETFs. Fidelity has zero expense ratio mutual funds that follow indices now, and Vanguard has ETFs that follow indices that come in around 0.06%, which is way lower than the numbers we're looking at right now. Start comparing funds from different institutions and find the mutual funds or ETFs that are best for you. If you're looking for info on some good funds that track an index, we have a video on that. Also, dividends are cool, so watch that one too. Thanks for watching, everyone. Take care.